Good afternoon, ladies and gentlemen. My name is Michalis. I'm one of the market analysts here at HF Markets, and I'd like to welcome everybody to a live stream webinar, which is going to be split up into three aspects. First, we're going to be looking at understanding what has changed since yesterday's inflation announcement. So, yesterday we had the consumer price index for the United States of America. It created a lot of volatility. A lot of it was as expected within the market. So we didn't have something which was as unexpected, should we say. So because we had an higher inflation than previously expected, we saw certain domino effects throughout the market. So this is point number one. We're going to be looking at that as the very first part of the webinar. Then what we're going to be doing is looking at the European Central Bank, looking at the interest rate decision, and looking at what that means not only for the euro but also for European-based indices. So this is what we're going to be looking at as part of today's webinar. Now, towards the second half of the webinar, as soon as we've gone through our slides, looked at how inflation and how the market has changed and is potentially going to change in the upcoming days because of inflation. We look at the ECB's rate decision. And then what we're going to do is go straight onto the MT5. We're going to be looking at live signals. We're going to be looking at technical analysis and looking at what kind of signals we're seeing in the market, what are indicators and price action pointing out to us? Are they going to point out certain types of price movements? This is what we're going to be looking at as part of today's webinar. Now, a lot of people probably know me, probably watched previous webinars of mine before, but for anybody who has not previously watched one of my webinars, just a bit of an introduction. My name is Michalis. I am a financial advisor and a market analyst. I have been for 10 years. I originally started off as a financial advisor. Actually, was in London, but since then I have moved to Europe, to Cyprus, where our head offices are, and I've been a market analyst for a further 6 years ever since. But of course, these webinars are not here to give you direct investment advice. But what we do want to do is give you as much educational material as possible and the right information in order for you to be active in the financial trading markets with confidence, with knowledge, and with expertise. So if you have certain targets, you know exactly whether those are responsible targets and how you potentially are able to achieve them. So this is what we look to do as part of our webinar series in general. Today, though, we're going to be looking at two specific events. We're going to be looking at number one, the ECB's rate decision, looking at why that's important, why that's going to have certain effects within the market. I've already had a lot of questions from individuals saying, is the statement of main importance? Is it the rate decision that's going to have the most volatility, or is it going to be the press conference? If anybody has questions like this, and of course you can ask as many questions as you like through the chat which is available to you. And of course, we will look to answer questions live as part of the webinar as well. And the second event that we're going to look at is the producer price index, both the core producer price index and the standard producer price index, which again is going to create a lot of volatility, is slightly more important than it has been in the previous months, very simply because we've had 3 months where inflation has consecutively risen and actually risen more than previous expectations, which is extremely important. Now, yesterday we saw inflation. We saw that inflation was higher than previously expected. Uh, what does this mean for the markets? Ladies and gentlemen, what this basically means is that the Federal Reserve, who have repeatedly said that yes, they of course want to adjust interest rates, they want to lower it to a more competitive region in order to be able to stimulate the economy and ensure that there is going to be what is known as a soft landing. And of course, that's ideal not only for stocks. Yes, it has that imminent domino effect on stocks, but it also can be positive, for example, for the US dollar and other US based assets, such as bonds, for example. But what it actually does mean, the fact that inflation has increased, they haven't been able to get that proof required in order to back a decision to reduce interest rates, even if they're only going to reduce it to a very minimal level, for example, 0.5% or 75 basis points. The fact that interest rate has come in higher and it's consecutively month after month coming higher, and at the same time we're still seeing energy prices increase, we're still seeing the employment sector extremely strong and resilient to the current level of monetary policy, even though technically speaking we are in that restrictive zone of the policy. We can very clearly see that the economy and the employment sector is resilient to that. So what is this meaning for the financial trading markets? It means that the Federal Reserve, ladies and gentlemen, is no longer expected to adjust interest rates. Previously, at the beginning of the year, we were expecting that they were going to adjust it as early as March. This is what was generally known within the market. But here, of course, at HF Markets, we repeatedly said that even though this is what is expected by the market, there is a lot of indications, we spoke about those again and again, that it's not going to happen in March. It didn't happen in March. People started to believe that it was going to happen in June. We looked at that over the past 10 days and we've really said, if inflation comes in not only higher than expected, but even if it comes in as expected, the possibility of that is very, very slim. Now, according to the FedWatch tool, I can actually show you the FedWatch tool towards the end of the webinar, because everybody has access to it on Google. You can see that the very beginning of the week, we were expecting a 65% possibility of a rate cut in June. Yesterday morning, it was reduced to 56%. It currently is at a 17% possibility. So it's very low. We're not going to see an interest rate cut in June. People are not even expecting a cut in the summer months. And at the moment, we are actually seeing the main likely outcome for the first cut to be in September, and also for the first cut, generally speaking, in 2024, for there to be between 2 and 3 interest rate cuts, whereas previously markets were expecting 3 to 4. So that's a very big change in the market. Now, why is this important to the European Central Bank? And I will explain this exactly now. We've got 3 slides to go through, and we've got 7 minutes to go through them before the announcement. I've got some questions here as well. Somebody, as I previously said, they stated, I can see on the calendar that there's a statement, there's the rate decision, and there's a press conference. What is the most important? To be honest, out of the survey of 62 leading economists in the Eurozone, only one believes that there's going to be an interest rate cut today. Now, because of that, and because of the very low possibility of that taking place, then of course, the rate decision is not that important unless we're going to see some adjustment. The reason why, if we see some adjustment, it will become important is because it is unexpected and it's not priced within the market. So people will start to price that in. But like I said, there's a very small possibility of that. So the likelihood of that having an influence is going to be very low. So even though your calendars will show it as something very important, it's not likely to have a very strong effect in the market. However, the statement and more importantly, the press conference will be extremely important. The statement hopefully will have some kind of forward guidance and will advise us some kind of, should we say, imminent interest rate adjustments. And I'll explain why potentially the European Central Bank wants to do that as quickly as possible. But if it's not going to be in the statement, because they don't want to give so much away and they don't want to be so dovish after the Federal Reserve is about now to become extremely hardened and extremely hawkish, they may not want to put it on the statement. But within the press conference, journalists will pressure the President Lagarde, to tell us when there is likely to be an interest rate cut and what are the possibilities of interest rate cuts. So the main importance, ladies and gentlemen, will be the press conference followed by the statement. Unless we're going to get some kind of interest rate adjustments, which is very unlikely, the rate decision is not going to be that important. Now, some people may say, why is the European Central Bank in such a rush to adjust interest rates? And this is one of the reasons, actually, why yesterday the euro significantly declined, and why it's also declining today, because the European Central Bank wants to be the first, sorry, they want to be reducing interest rates because the economy isn't necessarily within a recession, but they are seeing a prolonged period of stagnation. So it's not like in the US where they're looking at very strong economic growth between 3 to 3.5%. In the eurozone, it's barely they're barely avoiding a recession. So they really want to stimulate the economy. The only way the European Central Bank can do so is if they adjust interest rates, for them to lower interest rates, because it increases investor sentiment and it increases consumer demand and economic activity within the EU zone. So this is what they're looking to do, ladies and gentlemen. But what they don't want is to be the first central bank, by far the first central bank, at least this is something they want to avoid, the first central bank to be cutting interest rates while everybody else is staying, should we say, disciplined, hardened, and extremely hawkish. Now, if we're looking at, for example, inflation, people really are going to be able to see why the European Central Bank now believes they're getting closer to to actually get inflation to their target, reducing inflation, and getting somewhere where they can actually start to reduce their monetary policy. Now, it doesn't mean they're going to become, should we say, ultra expansionary, because there is still, especially in certain regions and in certain countries, there is still elements of inflation, but nonetheless, they want to lower it in order to boost confidence and boost economic activity. But you can see, ladies and gentlemen, I've said here very clearly, the largest economies within the Eurozone is Germany, France, Italy, and Spain. If we start off with Germany, ladies and gentlemen, inflation in Germany is at 2.3%. If we look, for example, at France, it's 2.4%. It is more or less at the target. It's exactly at where they want it to be. It's lower than they previously expected within the market as well. If we go to, for example, Italy, Italian inflation is actually extremely low. Ideally, they would like inflation to become slightly higher. So the inflation target is at 2%. The Eurozone inflation at the moment is at 2.4%. So you can see it's at exactly where they want it to be. It's actually lower than they previously expected it to be. So, ladies and gentlemen, it's at a zone where they can at least, at the very minimum, if not start cutting interest rates, to at least indicate that an interest rate is going to be imminent. And we can see that, ladies and gentlemen, very clearly and simply because inflation has reduced. And a very important factor as well, ladies and gentlemen, is while inflation has increased in other regions, for example, in Japan, for example, in China, we saw it in New Zealand as well. We saw it yesterday in America. While in other regions, inflation is increasing, it's also simultaneously decreasing in Europe. So they're able to tackle inflation, even though everywhere else, inflation is actually increasing. So you've got to understand that global economies, they're linked and they're correlated, and normally inflation comes hand in hand. Now, this, ladies and gentlemen, here, we'll look at this very quickly and we'll go straight to the announcement. Here we can see the economic growth within the Eurozone. You can see here, ladies and gentlemen, Eurozone economic growth is extremely low. I've got here as a title, Eurozone economic growth. There isn't any. Okay, so you can really understand here why they're in a rush to start cutting interest rates. Like I said, doesn't mean they're going to cut by 2% throughout the rest of 2024, but they're at least going to take into consideration a 0.5% cut up to 75 basis point at a very at least. And you can see here as well, Germany, France, Italy, largest economies in the Eurozone, really seeing very negative interest rates, ladies and gentlemen. Now, let's go to the announcement. The announcement is going to take place in a couple of seconds. By the way, if people have questions, again, feel free to ask questions at any point. I can see some questions here as well. Please, what are we expecting with the GBP to get strength today from the news? To be honest, we have to look at the announcement first. What I will say, though, ladies and gentlemen, is when you're looking at that category of the major miners, this is how it's known within the financial trading markets. Uh, this is basically the Japanese yen, basically the euro and the British pound, where it's not minor currencies, but it's not at the level of the US dollar. They normally take a hit depending on the strength of the US dollar. So, for example, yesterday the US dollar significantly increased in value. What you saw for both the euro, especially the euro as well, ladies and gentlemen, because the euro is more correlated to the dollar. But what you also saw with the pound, like this gentleman has mentioned, is that it declined against other currencies, not declining against the US dollar, but also declined against other currencies as well. So, for example, the British pound against Japanese yen, it declined. And it's because of the US dollar. So, the ECB's announcement is not necessarily important to the British pound, but it is, ladies and gentlemen, important. What is important is the US dollar to the British pound, because the stronger the US dollar is going to get, and more positive the news is going to be for the US dollar, the weaker potentially is going to be for the pound. So let's adjust our calendar. Here we go, ladies and gentlemen. So, as expected, as I mentioned just a couple of minutes ago, the main refinancing rate stayed at 4.5%. Keep in mind that is lower than most regions. It's lower than the Bank of England, and it's lower as well than the Federal Reserve. And also, the deposit facility rate is also kept unexpected. Is kept as expected at 4% again. The next most important announcement, and like I said, it's going to be the most important announcement, is going to be the European Central Bank President's press conference. So let's go now to the release, ladies, and let's go now to the charts and get a better understanding of what type of price movement we're potentially going to see. Now, I actually spoke about the euro against the Japanese yen in this morning's market analysis blog. So if you go to Google and type in HF Markets Analysis and you look at the article from this morning, we actually spoke about the euro against Japanese yen. We spoke about the euro against Japanese yen decreasing in value. If we look at the past 4 hours as well, we can see it has been decreasing in value. But let's look at from now onwards and not what we mentioned this morning. But what I want to point out is you can really see here the importance of the articles that we produce and release every morning, where we give signals, we look at the market and inform everybody what type of price movements potentially may be upcoming based on certain indications. And we can see today, as it was yesterday, it is 100% correct. Now, here we've got, ladies and gentlemen, the 75 bar exponential moving average. At the same time, we've also got a relative strength index on a period of 18. Some people may think the period of 18 is too high. It's not too high, ladies and gentlemen, because what we're doing is we're using this EMA and the oscillator here in order to give us indications. Number one, of the price sentiment, whether there's bullish sentiment or bearish sentiment, and also where the buyers or sellers are controlling the markets. So this setup, we've got it here on the 2 hour chart. So at the moment, ladies and gentlemen, we've started to see actually the weakness within the Eurozone here, ladies and gentlemen. So this was on the 10th, this was yesterday, as we started to approach the inflation release. We started to see the weakness. After the weakness, we started to range up and down between up and down, below and above the 75 bar exponential moving average. Now, if we're at the 75 bar exponential moving average, we're basically at the neutral level, neither getting indications or sell or a buy. But we can actually see higher highs and lower highs and lower lows as well. So it's an inverse symmetrical triangle. So it is indicating to us that it's not actually at a neutral, but is at at a level where there can be a lot of volatility. Now, if we're looking at the overall price movement, ladies and gentlemen, we can see the main swings. If we look at this swing here, this swing high, and this swing high, we can see we're looking at higher lows. If we're looking at the previous two lows here, we can see we're looking at lower lows, and we're attempting now, ladies and gentlemen, to decline onto a lower high, a lower low again. We can see the price is trading below the 75 bar exponential moving average, which is basically telling us that sellers are controlling the market, or at least attempting to control the market. If they start to, for example, uh, continue to gain momentum and decrease further away from the moving average, for example, like we saw here or like we saw here, then we can actually see a clear indication that actually Japanese yen is actually gaining control. So this is something that we can take into consideration. At the same time, here we've got the relative strength index, which is an oscillator, which is currently at the 41 mark, ladies and gentlemen. So it's below the 50, but above the 25. So we very clearly have an indication here that sellers. There's a bearish sentiment within the market. Now, some people may say, ladies and gentlemen, that we want to see a breakout to trade further. Okay, a lot of people tend to say this, ladies and gentlemen. Now, the issue is if you're going to wait for a breakout of this price level here, the issue here, ladies and gentlemen, is that you've missed the price movement of almost, well, it's actually smack bang on 0.5%. So you've missed 0.5%, a lot of volatility of price movement. And also, a lot of the time, if you wait for breakouts, you trade them very close towards the end of the next swing. So, for example, here you have one swing, and here you have a second swing. If I wait for it to break out of this level here, ladies and gentlemen, there's not much price movement there for me to take advantage of. So there's a different scenario that we're going to look at today, a different technique in order to ensure that we're entering at a more competitive, a better entry point rather than the breakout. But we're using this setup to clearly give us an indication that there's bearish sentiment and sellers are controlling the market. So because of that, when we switch on to a smaller time frame, so for example, here I've got a 5-minute time frame. Let's get the euro against Japanese yen. Here I'm on a 5-minute time frame, ladies and gentlemen. What we're going to do is we switched on to 5 minutes, and we're using this to get a better entry point. And I'll show you exactly how you can get a better entry point. Every time, ladies and gentlemen, that there is a retracement. So for example, here we very clearly had a retracement. Okay. Now, again, what people would do is they will draw a line here, okay, which is the low. So you can see this was the previous low from back here. And they'll say, based on that low, I'm going to wait for a breakout and then I'll trade after the breakout. Now, if you did that, again, you've missed most of the price movement. And since then, the price has moved in your favor 0.12%. To be honest, we're looking at short-term traders, and probably a lot of people are short-term and ultra short-term. 0.12% is probably more than enough anyway. But either way, okay, what we can do is we can draw the Fibonacci retracement, okay, which we can do from this here, and we can do it based on the low and the high. And what it will do is it'll come up with these lines here. The important line is the 61.8. Now, if the price breaks below the 61.8, which happened, ladies and gentlemen, on this candlestick here, okay, that is the point where we start to speculate. We've got a signal to potentially start to speculate the decline. Now, if somebody had an option to trade here, ladies and gentlemen, at the 100, which is the breakout level, or they have the option to trade at the 61.8, or should we say just slightly under that, of course, they're going to prefer to trade at the 61.8. It is a much better entry point, ladies and gentlemen. So you can see this is an extra 0.12%. So it's double the price movement, and double the price movement so far. Of course, we're still seeing volatility, ladies and gentlemen, as well. So what I'm doing is I'm using the retracement, and I'm using it to speculate the next continuation of the trend. But I'm only looking at signals of downward price movements. Why? Because if we go to the 2 hour, we're looking at the price being below the 75 bar exponential moving average. We're below the oscillator as well. We're below the neutral, that is. So here we've got signals the price is going to weaken. We don't want conflicting signals, ladies and gentlemen. We don't want conflicting signals. We want very clearly signals that the price is going to move in the same direction based on indications that we're also seeing on the 2 hour. So this is something people can take into consideration. Now, if somebody says, how can I open the next trade? Because of course that was a trade from approximately 20 minutes ago. I mean, it's not that long, but how do I open the next trade? Ladies and gentlemen, you can wait for the retracement again. Okay, so you can see it's already retraced. For example, we're looking at a retracement now of 0.14%, so it's already started to retrace. We do the exact same scenario. If it's easier for people as well, by the way, we can switch on to a 1 minute. Okay, still will work on the 5 minute as well, but if it's easier for you guys, you can switch on to like this. You can switch on to the 1 minute. We've drawn the Fibonacci zone here. And if it crosses below the 61.8, so I'll put a line here, ladies and gentlemen. So that's at the 164.010. Then you can use that as a continuation and indication of the price continue to decline. Now, ideally, what you want to do when you're trading currencies, ladies and gentlemen, is you don't want to look at it as a single asset. This can make analysis more difficult. What is, yes, okay, slightly more advanced, but what would make your analysis more successful is if you view it as three assets. So, yes, you're going to look at it as the euro against Japanese yen, but at the same time, you want to look at it as the euro as an individual currency and the Japanese yen as the individual currency as well. So, what you want to see is not what is known as a tug of war. Okay, when you have two currencies increasing in value or two currencies decreasing in value, because the direction is going to be more difficult to determine. And by the way, ladies and gentlemen, you can see why it's so important to be drawing these Fibonacci's and waiting for the breakout of the 61.8, because you can see the price is increasing upwards. So rather than just entering into that sell and waiting for it to decline, we're waiting for the momentum first. Okay, so there's a very big difference there, ladies and gentlemen. And of course, the larger the retracement is, that 61.8 will change. So for example, if the retracement continues all the way up to here, you can see that 61.8 is moving further up as well. So it's an earlier entry point. So for example, you don't want the euro to be decreasing in value and also the Japanese yen to be decreasing in value. You ideally want one to be increasing and the other to be decreasing, because that's when you're likely to see strong volatility, clear and a prolonged price movement. Okay, so what can you do? You can, for example, look here. For example, we've got the euro against the pound. We've got the euro against the US dollar, and you can see it's the same type of price movement. The euro is declining, but it's attempting to retrace upwards. So we can very clearly see here against most of the market, we can look at more euro pairs as well. So for example, we can look at the euro against the Swiss franc, like so. See what kind of price movement we're seeing there as well. Same scenario. And here, by the way, you can see there's a less of a retracement. Okay, so here what you can do is you can actually look at the Swiss franc. So for example, look at the pound against the Swiss franc. You can see the Swiss franc is increasing in value. You can look, for example, the Canadian dollar against the Swiss franc. You can see the Swiss franc is increasing in value. We can look at, for example, the US dollar against the Swiss franc, because the US dollar is definitely strengthening, ladies and gentlemen. But again, you can see the Swiss franc is increasing in value. So you can see that I'm trying to establish which currency is increasing in value against the whole of the market. So I can speculate it's increasing against the currency which is decreasing against the whole of the market. So that way we're not getting that tug of war scenario. We're getting a clear, strong price movement. And like I said, if you're doing that, if I go back again to the euro against the Swiss franc, you can see is seen a weaker retracement upwards if we're comparing it to, for example, the euro against the pound, in which case, like you can see here, there's not only a stronger retracement upwards, but there's also more retracements upwards. So a very big difference there. But so far, ladies and gentlemen, we're getting indications that the euro is going to decrease in value. This is so far the euro against Japanese yen. Let's also look at the euro against the US dollar, ladies and gentlemen, because we're about to get our inflation announcements as well. So let's get the euro against the US dollar. Here we go. Let's get it on a 5-minute time frame. And let's get our calendar back up. We get an upward price movement. Okay, so let's see why that is. Maybe the producer inflation has come in lower than previously expected. So let's have a look at that. So we go back to our economic calendar. Let's go to the United States of America, like so. Let's go to today. So here we go, ladies and gentlemen. We've got producer price index lower than expected. That, of course, has triggered that the yearly figure, it still has increased. It's still extremely high, ladies and gentlemen, much higher than what it needs to be in order to, should we say, prompt the Federal Reserve to consider altering interest rates. And in addition to this, we also need to take into consideration not only the core, not only the standard, but also the core. And if we're looking at the core figure, ladies and gentlemen, producer inflation for core inflation, so basically excluding more volatile assets such as food and such as energy, it came in higher than expected. So generally speaking, ladies and gentlemen, this, even though we got some two minor figures which were lower than expected, we're still getting unemployment claims lower than expected, which is positive for the dollar. We're still getting producer price index, the core producer price index, higher than expected as well. So, ladies and gentlemen, this is still indicating strength in the US dollar, even if we're going to see upward price movement. So, for example, here we're getting some upward price movement, ladies and gentlemen. Potentially, it could be related to the press conference. In order to establish this, you can look at the US dollar against other currencies, but you can see it is the US dollar that's decreasing in value. And we can see again, US dollar decreasing in value. But nonetheless, the announcement is positive for the US dollar. So we have to be cautious if we've got individuals that are going to speculate the decline. Now, some people may say, it's positive for the US dollar, but the US dollar is decreasing in value. So I don't know what to do about that. And also, that's a bad thing. It's not necessarily a bad thing, ladies and gentlemen. What it basically does, it's giving you an entry at a better price. It's like, for example, if I come to you and I say to you, I've got an apartment, it's an investment, I don't want it anymore, I want to sell it. I'll offer it to you for 100,000, and you say no. And tomorrow, and I come and I say to you, I'll offer it to you for 90,000. You say yes, because it's a better entry point. So we've got a lot of people that want to potentially speculate the US dollars increase, but they want to do it at a better price. So if it's declining, it's giving you that option to do it at a better price. But of course, you don't want to be trading against the market. So let's go over to our 2-hour time frame here. And we can start to look. Let's actually start to look at the euro against the US dollar, because we also will have the announcement from the European Central Bank. So here, ladies and gentlemen, we can see we're very far away from the 75 bar exponential moving average. We are very far away from the neutral, which is the 50 on the oscillator. We've got no divergence, so we've got no indications that the price is oversold, and it's not below 25 as well. So again, there's no indications that the price is oversold. So this is indicating to us that very clearly the euro is that sellers are controlling the market, so not in the favor of the euro. But let's say, for example, we do get some increase in the euro, ladies and gentlemen. Maybe, for example, it's going to increase to here. Okay, Again, what we're very simply doing is we're using our Fibonacci levels like this, and we're just going to use it to re-enter into the market. Now, ideally, you don't want to do it on the 2 hour because it's a very long-term chart. Um, and of course, when we're looking at derivatives, they're mainly aimed for short-term trading. But what you can do is you've got the Euro USD here. You can switch onto a 5 minute time frame. For example, you can look at a 1 minute, but 5 minutes is sometimes more ideal. And we can again very clearly just use this to get a better entry point. So the retracement, ladies and gentlemen, is here. We want the breakout of the 61.8. So here you can see the 61.8, ladies and gentlemen. Now, if we've also got scalpers, again, scalpers, a lot of the time, they look at where the price is at most of the time, and they look at the average price. So also, we've got a lot of scalpers that may potentially look at the volume weighted average price. This is also an option as well, in which case they're going to be looking at this region here. So individuals like that, they can also look at the 1 minute and maybe more beneficial to them. So if you're looking at the 1 minute, again, it can give you a higher entry point. Okay, so for example, here we've got a higher entry point. People can also look at from the average price upwards as well and look at the Fibonacci based on that, in which case, again, it's going to give you a higher entry point. But if you're going to do so, ladies and gentlemen, you have to be slightly cautious that the 61.8 is at the previous resistance point. You have to be cautious. It's not going to form something which is known as the resistance being flipped onto the support. So you need to be cautious about that. This is also why a lot of the time we always say there's that benefit to the 5 minute time frame, ladies and gentlemen. Also, yes, we're getting an upward price movement. There is quite a lot of volatility upwards, but we've got divergence here, ladies and gentlemen, as well. So we've got this increasing onto a higher high, but it's actually on a lower low when we're looking at this here, for example. So you can see here very clearly we've got a tilt downwards, whereas on RSI, ladies and gentlemen, we actually have a tilt upwards. So there's a slight divergence there, signals weakness as well. So this is something that we're going to keep monitoring, okay? Because yes, we've got increase, but we've also got in 7 minutes time, 8 minutes time, we've also got the press conference of the European Central Bank. The European Central Bank is going to come out and say, regardless of the Federal Reserve, we are still unchanged in terms of our policy, in terms of our view, and we are going to increase most likely if data continues to allow it. We are going to consider at least decreasing interest rates by a minimum of 25 basis points by June of this year. If they're going to come out and they're going to remain dovish as they've tried to avoid to sound a lot of the time, but nobody has really caught on to that. If they do start to sound dovish, then again, the euro is going to struggle to maintain its value. In which case, again, these Fibonacci levels here, ladies and gentlemen, are going to start to become more and more important. What else can you take into consideration? You can definitely look at these two crossovers. So let's slightly zoom in. So you can see the yellow has crossed above the blue. So basically, the 8-bar exponential moving average has crossed above the 18-bar simple moving average. If that crosses downwards, and we get the MACD bars drop below as well, so they're pointing downwards. And we've also got the RSI drops below the 50 again. That is very clearly indications that the euro against the US dollar will start to decline. So we're not only looking at price action, okay? We have to take that into consideration. We're not only looking at price action, we are also going to look at indications. At the moment, though, we've got conflicting signals. On the 2 hour, we have indications of a decline. On the 5 minute and 1 minute, we've got indications of it retracing upwards. So we wait for those to move side and side. Because, ladies and gentlemen, we don't want a low success rate. We definitely want a high success rate, as high a success rate as possible. Also note the volatility is going to change in the next 6 minutes when the press conference starts taking place. But even as the price has increased and people may be thinking, maybe I'll trade this upward price movement, you can see it hasn't increased any further since we've been speaking over the past, 9 minutes, 10 to 9 minutes. So you can see exactly why I'm saying that. You need to be cautious of it, ladies and gentlemen. Let's also look at the DAX as well. So bear with me. We'll actually look at the DAX on the 2 hour. Now, somebody said to me, based on the DAX, how low can the price go? What people can do is they can look at what is known as a regression channel. Sometimes we've looked at a two-zone regression channel like this. Some people prefer the three zone, in case it gives a third target which is slightly further away. You can also take that into consideration, of course. Here, though, I've got a two-zone. So if we look at the German DAX, here we go. We can look at this also to determine where potentially we're going to get the retracements continue to decline too. Now, because we've seen the regression channel thinning, we now actually have to wait for the regression channel to start widening. Even if it's going to start widening downwards, we want it to start widening, because as it declines, ladies and gentlemen, yes, it gives us targets. So for example, between the yellow and the red here, and then at the bottom of the red as well. This is the targets that we were getting as it started to decline. But we've already reached those targets. So now what we want to do is look at targets downwards. If it's going to continue to decline, or if it's going to start increasing in value, targets upwards. So far, we've only got one target in terms of the target upwards, which is this target here, which is more than enough price movement. But you've got to keep in mind, we've got looking at the regression channel. This is, by the way, 0.85%. You've got to keep in mind the regression channel is thinned. Ideally, you want it to see widened and no crossovers. So, for example, like this, ladies and gentlemen, you can see the price is increasing. It's above the regression channel, which is very good. Indicates upwards price movement, and you can see it's widening. It's not thinning, and it's not crossed over. So this, you can see, gives us a very, very clear indication of upward price movement. And since there, you can see increase by more than 3%. At the moment, though, we're at the neutral, and we want, if it's going to continue to decline, for that regression channel to start pointing downward. Now, people, an example of that, it's going to be difficult, definitely, because we're definitely looking at a very bullish market over the past few years. But this is an example here, though, ladies and gentlemen. So you can see it's started to point downwards, it's widening downwards, and there's no crossovers. And you can see on this previous example that we got bearish indications. Very clearly, we can see the price decrease by 3% and 3/4. But let's start looking at the 2 hour. 2 hour as well, indicating a decline. Here, ladies and gentlemen, we can see we're trading below the 75 bar, and we're also trading between the 50 and 25. The only thing here, though, ladies and gentlemen, is we have divergence. We're actually here forming higher highs. So if I take this line here, for example, you can very clearly see here there's an upward slope. But when we're looking at the price movement, we're looking at a downward slope. So this is indicating divergence. What does it mean? Potentially, it could be indicating that there's going to be a retracement upwards. If there's going to be a retracement upwards, it may retrace to this sentiment line again, in which case it could retrace and form something like this, okay? Potentially. But of course, we need to see that kind of indication on the 5-minute as well. So if you go to the 5-minute, and keep in mind, what's going to be the most helpful thing for the German DAX, ladies and gentlemen, is if we're going to get an indication from the European Central Bank that they are going to cut interest rates. Another positive thing is if global stocks start to improve as well. Okay, so if sentiment improves towards stocks, it's not only going to affect US stocks and equities and Asian stocks and equities, it will also affect European. So if we're looking at Fibonacci at the moment, we've already crossed upwards. It's retraced though. We want to wait for that to cross again back upwards. Okay, so this is for us to take into consideration. The only other thing that we can do if somebody's worried, because actually on the 2 hour we have indications of downward price movement, and people don't want to be trading on conflicting signals. The other thing that they can do is trade on a slightly higher level. So looking at the larger retracement here, sorry, the larger impulse wave here, in which case you haven't got an indication yet, but if it crosses over above here, you will get an indication. So that's something people can take into consideration. But if you want to continue, as the trend has been throughout the whole of April, and continue to speculate the decline, ladies and gentlemen, which is ideal based on what signals we're receiving, despite the fact that if they do indicate a cut, it is positive for the DAX. If you do want to trade based on technicals, ladies and gentlemen, this is the retracement. We can see the momentum volatility very clearly is towards downwards. If it declines and breaks below this level here, so at the 18,043 and a half, if it breaks below here, that's your signal, ladies and gentlemen. If it breaks before here, you can potentially speculate a decline there. And some people may say, why would I trade there? And why not instead trade at the breakout? The breakout, ladies and gentlemen, is here. All right. If you're trading at the breakout, you have to wait and miss out on 0.23%. So we've already established it's a downward trend. We've already established this is a retracement. It's not a higher high. It's not indicating in any way, shape, or form that we're seeing a change in the trend just yet. It may develop that way, but at the moment we're not seeing that. So we've already established the downward momentum. We just want the best entry point as possible. We don't want to trade against the trend. At the moment, the price is against the trend. Don't want to trade against the trend. So we want some momentum to start to build. Okay? People can, if they wish, they can use, for example, price action like this. Maybe slightly difficult because it's not much momentum. So I may, for example, hit that and just start moving back up because it's very close, which is why we use the Fibonacci. So it's not too far away, but it gives us a better entry point as well compared to this breakout here. So this is for the DAX, ladies and gentlemen. Let's look at US stocks lastly, and then we'll end today's session. Let's actually look at the Dow Jones, which is the worst performing index of April 2024. Because of that, it's more interesting. Sometimes it's easier to analyze, and also it had the highest volatility yesterday. Upward price movement, ladies and gentlemen. Again, so if people want to speculate the decline, very clearly we've drawn our Fibonacci levels here. This is our breakout point here, ladies and gentlemen. This breakout point here. This is something people can take into consideration. If the European Central Bank is very hawkish and hardened and saying they need more proof, they're not thinking about a cut, it's too early, and start to sound more hawkish just because the Federal Reserve are going to take that chance, take that stance, then again, this is also going to have a weakened effect and weaken the Dow Jones. The reason why, even though it's moving upwards, we consider potentially downward price movement. So far, it may change, keep that in mind, because there is volatility, but so far, that very simply because you can very clearly see here the downward momentum. Trading below the Fibonacci, trading below the 75 bar exponential moving average, and also trading below the RSI. What else can we take into consideration, especially if we're trading? Let me open a new page. If we trade in the Dow Jones, some things we can take into consideration is if you type in Dow Jones and components on Google, like this, you open this chart. This page will be very helpful for you, and I'll explain exactly why. Here you can see components. Okay, there's only 30 stocks within the Dow Jones. Here you can see the components, and they ranked. So you can see numbers here. The lower the number, so 1, for example, is the most influential stock. So of course you want, for example, from the top influential stocks, I may say the top 15, so everything above 3% influence and above, you want most of them to be increasing in value if you're going to speculate the increase. If you're going to speculate the decrease, you want most of them to be decreasing in value. So from 15 stocks, we have 1, 2, 3, 4, 5, 6, 7 in the red. So it's 50-50. So you can see here, that is not pointing to me at the moment that the Dow Jones is going to increase in value, nor is it pointing that it's going to decrease. Probably here, there's more of a tilt and a bias towards the increase, but not a lasting one. This is based on this picture. Of course, we keep refreshing, especially after uh, in about 40 minutes when the US session opens. This is something we can definitely take into consideration. The other thing, ladies and gentlemen, US bond yields, always the 10-year. Bond yields are lower today, substantially lower. This is a good price movement. This is indicating, if it's lower, it indicates positive price movement for stocks. Doesn't mean it's going to happen straight away, but generally speaking, that is its known domino effect within the market. And then we also look at the US dollar index. So this is something people can do. These 3 points here, ladies and gentlemen. Ideally, you want at least 75% of the components to be moving in one direction. So for example, like now, the US dollar index is probably lower. It is lower. So if you had a lower US dollar, lower bond yields, and 75% of these stocks were increasing in value, that's a great scenario where everything points towards upward price movement, potentially. If 75% of these are decreasing, bond yields are up, and the US dollar is up, again, that points to a decline. But again, you need to coincide this with technical analysis. At the moment, technical analysis is indicating that yes, it may have a retracement. Yes, we may have a retracement, bullish retracement like this or like this. But generally speaking, unless we're going to be saved by earnings season, which is actually going to start tomorrow, in which case, it may be saved. I'm not saying it's not possible. Definitely is possible. Over the past 2 years, it has done on a lot of occasions. Unless we're going to be saved by earnings season, that's pointing towards a decline as well. So we want to ensure we're not, going to look at a scenario where we're looking at conflicting signals. We want signals that move hand in hand and point in the same direction. So, ladies and gentlemen, we've been speaking now for 51 minutes. I don't want to take up too much of everybody's time. Trade safe, trade responsibly. If you have questions, you're more than welcome to ask as many questions as possible. I've got somebody here comments on gold. Gold, without a doubt, momentum indications will be indicating upward price movement, especially if the US dollar is going to decline, because people really start to look at that as inflation is increasing, likely to remain higher than expected and above target. We want something to hedge against inflation. If the US dollar is not working as a hedge against inflation, then you've got gold, ladies and gentlemen. Even before I've looked at that on the chart. And you can see, gold is increasing in value. So for example, here you can see an increase of, it increased up to 0.81%, so quite a lot. It's declined slightly, 0.65. Okay? So ladies and gentlemen, let's end. I've got somebody here that says, why do you use the 2 hour? The reason, ladies and gentlemen, I use the 2 hour is because it's neither a short term or a medium term time frame. If I start to use the 3 hour and 4 hour, it's a medium term time frame. So I want to use that very thin lining between the short term and the medium term. And simultaneously, I use the 5 minute, okay, which gives me that short term entry point. So hopefully that answers that question as well. So very interesting. We've now got the press conference. Let's end today's session so we can all go straight and start looking at the press conference, because I'm sure everybody wants to start trading. A lot of volatility, even though producer inflation was mainly higher than expected. We got something different on stocks and on the US dollar compared to yesterday. But we have to keep in mind and be watchful that scenario doesn't start to build momentum again. So let's end today's session. Trade safe, trade responsibly. If you have any questions, you're more than welcome to feel free to get into contact with us. You can, of course, register for free on our platform, in which case you get free educational material such as webinars. Also, you get signals, you get extra trading tools. We have for free, for example, swap free accounts. You can trade swap free. We have spread free, low spread accounts as well, and so on and so forth. So, thank you everybody for joining. Enjoy the rest of your day. Good luck. And if you have any questions, feel free to get into contact with me at any point. In the meantime, trade safe, trade responsibly, and we'll speak to you very, very soon. Goodbye.